Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
How's the USD been behaving?
Well, the US dollar practically fell substantially on Mondays, especially during the Asian session. That tended to imply that the 8-week winning streak of the US dollar may be over. However, that's still uncertain. We'll have to wait and see how the week progresses. During today's Asian session, more or less tended to regain some of the losses of Monday. So there were some mixed signals in the market, in the FX market, in the past 24 hours. I think the main test for the US dollar is going to be the release of the US CPI rates for August. For the time being, the headline CPI rate is expected to accelerate, both on a month-to-month as well as on a year-on-year level, which may more or less imply that inflationary pressures are quite persistent, and that may sharpen the Fed's hawkishness. So overall, should the rates actually accelerate, maybe even more than what was expected, we may see the US dollar getting some support. Other than that, I would expect today the US dollar to be led mostly by fundamentals, given that we have a low number, if any, or financial releases of high impact.
And how about US stock markets?
For US stock markets, I would be highlighting practically the IPO of ARM. The British chip maker practically snubbed London Stock Exchange, is going for NASDAQ. It's expected to be the biggest IPO of the year. And there are already reports that it's overbooked, so demand seems to be high, and that may lead the share price at the high range. Overall, we expect that should the IPO go well, we may see a bullish sentiment start leading the shares price. There is a small catch here. It's the sensitive nature of ARM's business, given that it's a chip maker. Microchips are currently exactly in the spotlight, given the US-Sino tensions, the sanctions of the US towards China. So I think it's going to be an interesting outlay on how the shares price will be behaving after it floats.
And what about gold?
Gold had an interesting behavior. We saw an intensification of a bias for a bullish outlook for gold in the past week. I think we saw also stabilization in the past 48 hours. It was characteristic that gold's price was unable to actually take advantage of USD's weakness, and the negative correlation between the US dollar and gold's price seems to have been at least temporarily interrupted. The next big test for gold's price are expected to be the release of the US CPI rates on Thursday. They are for August, and normally, given that gold is also an inflation hedging instrument, could get some support from an acceleration of the US CPI rates, but the negative correlation with the US dollar may reemerge, and in that case, should the US dollar gain, we may see gold's price weakening.
And back in the FX market, are there worries for the euro?
Yes, there are substantial worries for the common currency. We highlight today's CEF indicators for September for Germany. For the time being, the expectations are for the indicators to show a more pessimistic outlook for the German economy, and at the same time worsening conditions on the ground, which does not bode well for the euro, given that Germany is the powerhouse, the economic powerhouse of the eurozone. I would expect, though, the highlight for euro traders to be on Thursday, the release of ECB's interest rate decision. The bank is expected to remain on hold. However, that's a pretty thin line. ECB hawks are pushing for another rate hike. And should that be the case, we may see the euro getting some asymmetric support as it may take the markets by surprise.
And how about the pound?
Now, pound traders, the pound is relatively stable against the USD. That's something we'll see later on in the technical analysis presentation. However, I would be noting on a fundamental level that we had, during today's early European session, the release of UK's employment data. The unemployment rate for July ticked up, yet the shocking elements were A, the employment change figure, which dropped deeper, way deeper into the negatives. It was at minus 66K, it dropped to minus 208K, if I'm correct, while the average earnings growth rate accelerated. Now, the release as such tends to imply two elements. The first element is that the ability of the UK employment market to actually create new jobs seems to have been hit. That's one. The second is that the acceleration of the earnings growth rate may imply that the UK employment market is going to continue feeding inflationary pressures within the UK economy. On the one hand, that pressures BOE to ease its hawkishness. On the other hand, the possibility of further inflationary pressures forces the arm of BOE to continue hiking rates. Something which was more evident also in statements made by BOE officials yesterday. We had BOE's chief economist Hugh Pill, and during today's Asian session in Canada, BOE's Monetary Policy Committee member Catherine Mann both more or less made hawkish comments, implying that the possibility of another rate hike is near. And I think that in the long term, should that be maintained, that feeling of another rate hike be maintained, we may see the pound getting some support.
And what about the Australian dollar?
The Australian dollar is a little bit tricky. On the one hand, we have also traders focusing on the Australian employment data for August. That's on Thursday's Asian session. Forecasts are practically for the employment change figure to rise up from the negatives and come, I think, up to 24K, while the unemployment rate is expected to remain at relatively low levels at 3.7%, which implies a relatively tight employment market. Should the rates and figures meet their respective forecasts or even be better than expected, that could provide some support for the Aussie. On the other hand, though, Aussie traders maintain substantial worries about China, which is a close trading partner of Australia. And I think they will be focusing on Friday's Chinese releases, which include two rates. The first would be the industrial output growth rate. It's for August, as is the urban investment growth rate. Now, should these two rates accelerate, that would be positive news, as that would imply an increase of Australian raw material exports towards China. On the other hand, should we see a substantial slowdown, then we may see the Aussie weakening. Mind you that since Friday, we have strikes at Chevron's LNG facilities in Australia, and that does not exactly bode well for the Aussie. There's some slight instability there.
And last but not least, is the yen still strengthening?
The yen got some substantial support during Monday's Asian session and may have been the main determinant behind also USD's weakening. I would be noting that the comments made by BOJ Governor Kazuo Ueda on Monday's Asian session, where he more or less expressed an optimism that the bank will be able to escape negative rates, tended to provide some substantial support for JPY. However, the Japanese currency against the US dollar was not able to escape its sideways movement, while during today's Asian session, we saw JPY relenting some of Monday's gains. So more or less, I think that the effect of Mr. Ueda's comments is slowly fading away. And nevertheless, monetary policy may be a key driver behind JPY's movement in the coming days.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosef.
So, welcome to the technical analysis part of the presentation for today. My name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame, unless otherwise stated. So let's have a look on how the US dollar has been behaving. Moving to the daily chart, it's interesting how the US dollar has been on the rise over 1, 2, there was interruption here, but still 3, 4, 5, 6 days. And yesterday's downward movement more or less tended to interrupt it, but today has been on the rise once again. Back to the 4-hour chart, especially in the European session, that should be more than evident. Okay, let's make some readjustments here. I'm definitely going to have a look on where the R1 is standing. That's the 105.50. And let's have a look where that's holding. Okay, there's a clear peak here, which was around May. Other than that, drilling to the daily chart once again, you can see that there was no substantial movement threatening that level. I'm keeping it for the time being. Back to the 4-hour chart, readjusting it. Let's place the labels. Starting with the R3, which is at 108.30. In green. That should be in red. There you go. A new label at 107. And another one at 105.50. Let's reaffirm that. Yep. Let's move now to the support lines. Placing the 104.40 as the next first support line. In green. Let's readjust the level a little bit. better. It's a level which was actually tested yesterday. You can see it once, twice, 3 times. Let's have a look at the S2 at 102.95, could be 103. We're talking about areas always. And the last support line at 101.9. Sorry, that should read S3. Let's correct that. That's it. So for the time being, we tend to maintain a bias for the sideways motion of the pair to continue, of the index to continue. The RSI indicator has just risen above the reading of 50. It's actually right now at 54, which also tends to imply that the market has still not decided on the direction of the pairs of the index's next leg. Should the bulls take over, and for bullish outlook, I would require the index to rise above the 105.50 and start aiming for the 107. On the flip side, should the bears take over, I would require a clear break of the S1 104.40 and for the index to start aiming for the 103 support level there too. For the time being, we tend to maintain a bias for the sideways motion to continue as mentioned before. Let's have a look at Euro USD. Let's place the labels. Let's start with the S3 at 1.040. Give me a sec. $0460. The S2 at 1.058. The S1 1.067. Okay, verified. Now the R1, we saw that the movement practically pushed the resistance line a little bit higher. Somewhere here, you can see the peak, but you can see that this level was also tested to the downwards, which tends to verify its validity. Let's keep that at 1.0770. So the first label for the first resistance line. Second resistance line being placed at 1.0865. And third resistance line at 1.10. One zero too many. That's it. Once again, a sideways motion seems to be prevailing between the R1 1.0770 and the S1 1.0670. The RSI indicator is below the reading of 50 but rising and nearing it once again, implying once again a rather indecisive market, which could allow the sideways motion to continue. Please note how the 20 moving average, which is the median of the Bollinger Bands, the blue line here, has flattened out. The Bollinger Bands as such tend to remain rather narrow, which may imply low volatility. Once again, a feature which could allow the sideways motion to be maintained. Should the bulls take over, we may see the price action of EUR/USD breaking the R1 1.0770 level, which was tested here during today's Asian session, but also tested to the downside as we have mentioned before, and start aiming for the R2 1.0865. On the other hand, should the bears take over, we may see the price action of EUR/USD dropping, breaking the S1 1.0670, and start aiming for the S2 1.0580. Let's have a look at cable. Readjusting the chart. Okay, some readjustments are necessary here. Definitely, I'm going to be readjusting the R1, lowering it to this level. Why? Because we have a nice touch here and a nice touch here. Also, I'm going to be raising the S1, better reflecting the sideways motion of the pair. The R3 could be lowered here, but it's still a wide way off. Let's have a look where the second and third support line are actually based. Okay, nice touch here. I'm keeping that. Let's move lower. And nice touch here and here. Okay, those are both valid levels. Let's place some labels now. Starting with the R3. At 1.2795. Now let's place the second resistance line at 1.263. First resistance line being placed at 1.2535. First support line. Let's have a look where that stands. And that's at 1.2445. Second support line at 1.2310. And final support line at 1.22. Now, I know that the number of analysts which tend to keep their support and resistance lines intact, I do not follow that rule that much. I try to more or less be able, through the resistance and support lines, show the limitations of the freshest movement of the pair. Okay, definitely if I have to, I will go back, further back, in order to see some support and resistance lines which I will not be finding in the present price action. But overall, I think that, say, for example, in this case, we can see how the limitations of the upward movement in the past 72 hours of GBP/USD to the upside was limited by the R1 1.2535, as it was tested here, even slightly breaking it. On the other hand, to the downside, we can see that the S1 1.2445 held its ground against the downward motion of the pair. It was very, very characteristic. You can see the channel behind it. And practically how the downward motion stabilized at this level. It was aimed for once again here and maintained a sideways motion. And actually that tends to lead us in maintaining our bias for the sideways motion to continue between the R1 and the S1. One small word of caution here. Please note the RSI indicator, which has dropped below the reading of 50. It's actually at 38 right now. And that tends to imply the buildup of some bearish tendencies within the market sentiment, which could drive cable lower. Now, for bearish outlook, I would require cable to break the S1 1.2445, which is the barrier of the downward movement, and start actively aiming for the S2 1.2310. So a mere breaking of the S1 may not be enough. We have to see a clear downward movement towards the S2 1.2310. Even if it's not broken, I mean the S2, definitely the price action of cable has to start nearing it in order for us to switch our bias for sideways motion in favor of the bears. On the other hand, for bullish outlook, we would require the pair to rise, break the R1 1.2535, practically scoring a higher peak than this one, and start aiming for the R2 1.2630. Very interesting chart. Let's have a look also. It's the final chart, and it's going to be on USD/JPY, which we have discussed. Pretty wide, but the sideways motion seems to be prevailing as well, with the first resistance line being set at 147.80. Sorry, that should be in red. The second resistance line at 149.40. There you go. And third resistance line at 151.50. First support line being set at 146.10. In green. Second support line at 143.75. Let me check that. I think it's 143.70. Don't know why. Yeah. Okay, let's make a small correction here. And last but not least, the oh my god, that's the S3 at 141.6. That's the S2. Let's label it. There you go. Quite an interesting chart in the sense that, okay, definitely note how weather's comments during the Asian session on Monday supported the JPY, which dropped from the highs of the 147.80 to the lows of the 146.10. May I remind you that these levels were preset, so there was no change. Overall, I would be highlighting the resistance line, the R1, is more or less was tested once, twice, 3 times, while the S1 was tested initially here, but also to the upside here, yet it was reaffirmed yesterday during the Asian session. Practically, the drop reaffirmed the lower boundary of the current sideways motion of the pair, and for the time being, we tend to highlight the continuance, the possibility of a continuance of the sideways motion between the R1 and the S1. Also note that the RSI indicator tends to remain near to the reading of 50. It's actually just below it, but it's too close to say that any bearish sentiment seems to be building up. On the contrary, the market seems to remain rather indecisive on where the pair is heading to, and that could allow the sideways motion to be maintained between the R1 and the S1. Furthermore, the moving averages, we're talking about the 50 and the 100 moving average, the 50 and the 100 moving average, the 50 moving average in green, the 100 in orange, both have flattened out. Note that the distance between the two moving averages remains the same, exactly highlighting that the tail tends to more or less favor the idea of a sideways motion continuance. So overall, the base scenario here is that USD/JPY is expected to remain rather stable within a corridor of around 170 pips. Should the bulls take over, which is a possibility and it should be covered, in that case, we would expect mostly USD to gain or JPY to weaken, take your pick. And at that case, the upper boundary of the sideways motion is expected to be broken. That's a prerequisite for any bullish outlook, and it has to be broken clearly, and the pair to start aiming for the 149.40. On the other hand, should the bears take over, we may see the price action dropping, breaking the S1. That would be the 146.10, and start aiming for the S243.7. At this point, I would like to highlight for the particular pair, okay, it's a little bit more on the fundamental side, that we may see a number of factors affecting USD and JPY. On the one hand, definitely the release of the US CPI rates for August on Thursday's American session could have a substantial impact on USD/JPY. JPY may prove to be a little bit more sensitive to the CPI rates of the US. At the same time, I would be highlighting, though, also factors which tend to affect the JPY side of the pair, and those would be namely BOJ's ultra loose monetary policy stance and whether that's about to change or not. Any further indications besides Governor Wetter's comments on Monday could provide some affirmation of the market's idea that BOJ is about to change stance. That could provide some support for for JPY, driving USD JPY lower. The second element, which should be taken care of in both sides of the aisle, would be safe haven inflows. Should there be especially more tensions between China and the US, we may see both the US dollar as well as JPY getting some support. I have a small hunch here that JPY may prove to be a little bit more sensitive and gain more, causing USD JPY to weaken. However, that remains to be seen. We hope that you found the presentation useful. From all of us here at IronFX, best wishes for solid trading.
To part 2 of liquidity and volatility. In this video, we will talk about volatility in Forex. So what is Forex volatility? In simple terms, volatility refers to an up or down market movement. For example, you expect a stock to be at one price, but it drastically goes up or down over a short period of time. This is considered a standard deviation from the expectation. Such a movement reflects volatility, assuming that there are remarkable changes in the value of a position. This is called a highly volatile position. On the contrary, when the position is stable, this is referred to as low volatility. Uncertainty is one common factor causing high volatility. However, if a position is highly volatile, it will potentially generate more revenue. Of course, it goes without saying that in such a case, you should be aware of the risks involved. Now, how can you determine stock volatility? You should just trade the trend. Keep in mind that when we refer to volatility, we refer to swings. You should look at the volatility index chart and determine how serious the price fluctuations of a stock market are. The sharper the ups and downs of a stock, the more volatile it is. Volatility is important as it helps you understand if a stock fits your trading portfolio and goals or not. All in all, it is either an extreme ride or an easy slide. Your choice. Thank you for watching. Stay tuned for more videos.
So today's session, as I mentioned earlier, is about trend trading. So as per usual, just a disclaimer before we get started. A risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all of your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice and/or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who were finalists for Best FX Research and Best Equity Research in the years 2019, 2020, and 2021. So here's our agenda for today. We have quite a number of slides to get through. So if you have any questions throughout the webinar, feel free to pop them into the chat or in the Q&A session, and I'll be happy to answer any questions you have. So this is our agenda for today. Firstly, we'll go through what exactly is trend trading and how to identify a trend using trend lines and channels. And then we will look at the different indicators that you can use and how you trade using these indicators. Next, we'll look at a couple of disadvantages of trend trading and how you can overcome these disadvantages. Okay, let's get right into it. So what exactly is trend trading? So it's a popular strategy used in Forex markets by traders to take advantage of the directional movement of currency prices over time. So as a beginner, understanding trend trading can help you to make more informed trading decisions. So trend trading is based on the idea that currency pairs tend to move in certain directions for extended periods of time before reversing. These movements can be upwards, referred to as an uptrend, or downward, which would then be referred to as a downtrend. So the goal of trend trading is to identify and capitalize on these sustained price movements. So statistically, a trend is more likely to continue than to reverse, and that's why a trend is assumed to be in effect until it gives a clear signal that it has reversed. Hence the sayings, the trend is your friend and you should never go against the trend. But of course, there are a couple of exceptions to this, so we'll talk a bit about those later on in the webinar. But the general rule is that when you follow these trends over different time frames and stay away from markets when they are not trending, then traders can then increase your profits by making these opportunities. So how exactly does it work? Excuse me. So here's just a simplified breakdown of how trend trading works and a couple of steps that you can take. So firstly would be identifying trends. So this would be an uptrend would be higher highs, and then a downtrend would then be lower lows. So this is typically done by analyzing historical price charts. Next would be your entry points. So once you've identified the trend, the next step is to find an opportune entry point. So over here, I've given an example of an uptrend. So during an uptrend, you might want to look to enter a trade and when the price has retraced slightly from its recent high. So this suggests that the trend will then continue. Alternatively, in a downtrend, you might look for a retracement before the price continues in its downward movement. Thirdly, we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So SL is stop loss, TP is take profit. Just to be sure. Okay, so a stop loss is a predetermined price at which your trade will automatically close and limit potential losses if the market moves against you. So this is also a risk management technique that we'll talk a little bit later. Next, a take profit level is where you decide to exit the trade to lock in your profits before the trade potentially reverses. Next, for number 4, we have riding the trend. So once you're in the trade, you have your risk management levels, so your stop loss, your take profit levels, all accounted for. Then, and your trend continues, then you can aim to stay in the trade as long as the trend remains intact. So this involves monitoring the price movement and adjusting your stop loss and take profit levels if needed. Number 5, exit the trade. So eventually you can expect the trend to reverse or weaken. So at this point, you might decide to exit the trade and take your profits, because it's important to note that trends will not last forever. So it's important to observe your trades and be vigilant and not get too greedy. Lastly, practice and analysis. So this is pretty self-explanatory. Like any trading strategy, trend trading requires practice and analysis. So you want to keep refining your skills by studying the charts and learning from your successful and unsuccessful trades. And of course, keeping updated on market news and events that could impact currency prices. Okay, so we talked a little bit about setting stop loss and take profit levels. So I just want to dive into that a little bit. So firstly, we have a retracement, which is what we talked about in the previous slide. So let's start off with pullback support and resistance. So pullback support is a strong level of support and it breaks out from a previous resistance level. Now price is dropping back to visit it again. So a tip is that when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. Here we're talking a little bit about Fibonacci levels, but if you're a bit confused about those, not to worry, we have an entire Fibonacci series on the different types of Fibonacci's. So you can go ahead and take a look at those. But the point that I'm trying to drive here is basically the introduction of a pullback support and resistance for your that could be used as your entry and exit levels. So pullback resistance works well when it breaks a significant low, as you can see from the chart here. So it breaks the level and then it makes a significant swing low and then it starts to pull back to this level. So that's why we call it a pullback. So we advise that it's even better if there are multiple Fibonacci levels that are lining up with it. So here's an example of a pullback support. Here we have 3 swing highs that line up in the same area. So remember that these are typically areas, not so much levels. So we have 3 areas that line up and price has passed through this level and it looks like it's made a swing high and it's coming back down to bounce off of this level. Excuse me. So here we have, we're expecting price to bounce off of this level, and that's why we call it a pullback, because we're expecting price to pull back to this level. So this green area here is now considered a pullback support level. Okay. Next, let's take a look at the pullback resistance example. In this example, we have 3 swing lows that line up in the same area, as you can see from this green area here. So the green area is our support, but once price breaks out of this support level, and we are expecting it to reverse off of it, then you can call it a resistance, a pullback resistance. Okay, so as you can see from the arrows, we're expecting price to pull back to this level here. So here's another example, but over here we have a actual example screenshot from a chart. So we have a swing low here and price is moving up. It's made a reversal over here. That's another way that you can identify trend reversals by looking at the swings, but we'll get into those in a little bit. So we have a swing high here, swing high reversal, it's going down, and then it surpassed the swing low support, and that's why we are expecting it to reverse back to the support level. But now that it's surpassed this level, it's now a resistance. So it is a pullback resistance in this case. Okay, next we have another pullback resistance example here. Actually, this is a follow-up from the previous slide. So this is the previous slide. We're expecting price to reverse off, and that's exactly what it did. So it reversed off of this swing low, reversed off, and it hit it right back to our pullback resistance, just as we expected. But what happens when price reverses off of this pullback resistance? So that's what we call a overlap support or resistance. So this overlap support and resistance basically occurs when price reacts off of a particular level from the top and from the bottom. So basically it means that when a swing low, as you can see from the GIF, lines up nicely with a swing high, then that's what we call an overlap level. So the more times that it reacts off of this level, the stronger the overlap area. This means that there are bulls and bears that are respecting this area, and that's why it's so important to take note of these areas. Okay, another pro tip, so if the overlap area lines up with other elements such as Fibonacci or graphical elements, it will make it even stronger. Okay, so here's an example of an overlap support or resistance. So it's basically a pullback support or resistance, just that price has actually reversed off of the level. Okay, so swing low support becomes a pullback resistance, as you can see from this screenshot. Once it breaks the support at this 105.643 level. So here in this GIF, you can see how price retraced back to this level or pulled back to that level, and then it proceeded to reverse off of that level. So once the reversal occurs, then it is an overlap resistance. Okay, let me know if there are any questions so far, but I hope this is pretty straightforward. Oop. Sorry about that. Press the wrong button. Okay, next slide. So now we're looking at a combination of the pullback and overlap levels. So here we have a big swing high resistance level, as you can see here at the first red arrow. And then it becomes a pullback support where we expect price to pull back or retrace this level once it has passed that swing high resistance. So it passes it, and then we're expecting it to come back to it. And that's why it is now a pullback support. Once price actually touches that pullback support and it reverses off of it or it bounces off of it, then we can call it an overlap support instead. Okay, you can take a look here for a while and let me know if there are any questions so far. But we do have a couple more examples in case you are confused. Okay, let's move on. So here's another example. We have a multiple swing high resistance. You can see from the purple circles here, one swing high here and one swing high here. Next, at point number 2, I have an arrow indicated here. That's where price surpasses the resistance. So price surpasses the resistance, and then we call it a pullback support. So you can see how the resistance then changes to a support level once price surpasses it. So we are expecting price to pull back, and then it did. So point number 3, price has pulled back to our support and has in fact bounced off of it twice. So at the blue circles, you have 2 swing lows that line up nicely with these 2 swing highs originally. Once price has bounced off of this level, the 0.68745, then you can call it an overlap support. Okay. Our last example before we get into how we can identify a trend. So our last example, pullback and overlap. Here we have multiple swing low supports, 1, 2 here, and then price has pulled back, or rather it has surpassed our support level, multiple swing low support. So it surpassed it, and we are expecting it to reverse back. We're expecting to reverse back because we have observed this swing low. Okay, so we observe the swing low, we see price approaching it, and we're expecting price to reverse off of it. And you can see that's exactly what happened. We have 1, 2, 3 swing highs that line up nicely, and they're all making it an overlap resistance instead. So we see price then break out of this overlap resistance one more time. In this case, since it was a resistance here, once it breaks out of that resistance, it's now a support level. And as usual, we're expecting it to pull back, which is why point number 4, it's a pullback support. And lastly, point number 5, price has pulled back to our support and reversed off of it, making it an overlap support. So you can see the swing low here, reversing right at the exact same 33420 support level. Okay, any questions so far? Okay, okay, no questions. Let's move on to our next part of the webinar. How do you identify a trend? So this brings us to our next point, which is identifying trend lines as well as trend channels. So these can really help you to identify a trend. But how you identify a trend is pretty straightforward just by looking at a chart. I'm sure you can tell whether price is moving up or down. And it's also important to note that you should be looking at the different time frames for the specific asset that you are looking at, and not just at the time frame that you are analyzing. So it's important to get an overall view of the direction of where prices are headed towards. So upwards, downwards, or ranging. Okay, so let's get into how we can draw valid ascending trend lines. So ascending trend lines should be drawn from the bottom and not from the top. So here we have an example. And trend lines should also have at least 3 significant touches in order to be considered valid. Because 2 touches tend to be more coincidental, and that's why we go for at least 3. Okay, so here's a couple of examples to show you how significant exactly these swing lows should be. So I have one really big swing low here and one swing low here. So that's how clear your charts should be when you are analyzing for trend lines and trend channels. Here we have another example, 3 trend lines, or rather 3 points touching the trend line. Actually, we have another small point here. And now for descending trend lines. So same thing, a descending trend line should have at least 3 significant touches as well. But for descending trend line, the lines should be drawn from the top and not from the bottom. Okay, here's an example. Here we have really nice 4 swing highs that touch our trend line. Okay, once again, take note of how clear the price movement should be. Yeah, you want to look for something with really clear movement in price. You can see exactly where the peaks are and the troughs are. Here's another example of a descending trend line. So you want to watch out for at least 3 significant touches in order for it to be considered a valid trend line. And here you see price playing the reaction off of the 4th touch. So it is breaking out of the 4th touch, 4th swing high on this trend line. Okay, so here we have a little activity. Let me know in the chat or in the Q&A session if you think this trend line is valid or not. In this case, of course, we can all agree that price is moving downwards. So we are expecting to draw a descending trend line. So let me know if you think this trend line is valid or not. Okay, so this trend line is not valid because remember for descending trend lines, we want to make sure that we draw the line on top of the charts. Okay, next, let's take a look at drawing valid channels. So channels typically require at least 4 significant touches to be considered valid. You need 2 at the top and 2 at the bottom. But they don't have to be in consecutive order like what we see in the picture here. Okay, so here are some examples. We have a descending trend channel here. Remember, 2 touches on top, 2 touches below. And once again, take note of how clear the charts, or rather how clear the price movements should be. Here we have an ascending trend channel. So, of course, it doesn't have to be in consecutive order as we mentioned earlier. Doesn't have to be in consecutive order. You can have some price movement in the middle. But as long as there are 2 touches on top and 2 below, then it's considered a valid trend channel. So these are just some graphical tools that you can use when you're trying to identify a trend. And this is typically the first step whenever we want to analyze a chart. So if we have time after the slides, I'll go through maybe one setup. I think we only have time for 1 or 2 setups. So I'll definitely go through the different steps that you can take to identify a trend and how exactly you can use that in your trading strategy. Okay. Next, we have the different indicators that you can use to identify the trend. So we're going to be talking about the different indicators that you guys can use, but let me know in the chat what are your favorite indicators to use. Yeah, just curious to know how many of you guys actually use some of these trend indicators. Firstly, we have the Ichimoku cloud. So I'll just briefly go through how exactly you can use the Ichimoku indicator. But I wanted to mention that this is not a webinar for Ichimoku strategies. So we have another webinar that is solely about how we can use Ichimoku, not just the cloud, but the different lines involved as well that I'm going to talk about in the next few slides. So you can go ahead and take a look at that webinar instead. But for this webinar, I'll just be breaking down the different lines and giving you a summary of how exactly you can use it. Okay, so the Ichimoku Kinko Hyo is a technical analysis tool that's used in Forex trading. So it consists of several elements, several components, including the Tenkan-sen, the Kijun-sen, Senko span A and B, and the Chikou span. Okay, I hope I'm pronouncing those right. But basically, these lines include a 9-period average, 26-period average, average of these two averages, 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. And how people use Ichimoku for trading is basically 1, to identify trends, 2, as support and resistance, and 3, confirmation, as well as buy and sell signals. So if we're just looking at the cloud only, which is the most, I guess is the fastest way, because you just look at it at one glance, it tells you exactly what the indicator signals are. So over here, I'm telling you guys that when price is below the cloud, then the trend is downwards, or it's suggesting a downward trend. When the price is above the cloud, then the trend is typically upwards. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud will be moving up, or during a downtrend, then the bottom of the cloud will be moving down. So the top of the cloud, the bottom of the cloud, these both have names as well. So you can see over here. So we have the Tenkan-sen, which is the conversion line, which is the average of the highest high and the lowest low over 9 periods. The Kijun-sen, or the standard line or baseline, is the average of the highest high and the lowest low over the past 26 periods. Chikou span, which is the lagging span, is the current closing price plotted 26 periods behind the current time. So these are pretty technical meanings of what the lines mean. So, but we typically will only look at the cloud. It depends on your own trading strategy. Okay, next we have explaining the lines. Oh, I didn't talk about the Senko span. Okay, so Senko span A, or the leading span A, is the average of the conversion line and the baseline plotted 26 periods ahead of the current time. And that is a leading indicator of the trend. For Senko span B, T is the average of the highest and the lowest low of the past 52 periods plotted 26 periods ahead of the current time and used as a leading indicator as well. Okay, next we have explaining the lines and identifying trends. So here we get into what each of the lines, or rather how you can use each of these lines. So the first way is to use Ichimoku to identify trends, which the Tenkan-sen and the Kijun-sen can help you with. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen. So Tenkan-sen is the conversion line and the Kijun-sen is the baseline. Yes, correct. Okay, so over here in the chart that I've included, the Tenkan-sen is the blue line or conversion line, and the Kijun-sen is the red line or the baseline. So bullish trend occurs when the blue line crosses above the red line. And then a bearish trend occurs when the blue line crosses below the red line. Okay, next, the second way is for support and resistance. So this is just extra. So the first way was to identify the trends. Now the second way is to identify potential support and resistance levels. So the Senko span A and B, which I mentioned earlier, are the leading indicators. These can determine support and resistance levels. So if the price is above Senko span A and B, then it's considered to be a bullish market. So in this case, Senko span A and B as you can see in the screenshot that I took from TradingView, you can see that these outline the clouds. So it's basically used as the same way as I mentioned earlier. When price moves above the cloud, it's bullish. When price moves below the cloud, then it's considered bearish. So same thing, if price moves below Senko span A and B, it's considered a bearish market. And these lines can also act as resistance levels, since they are specific levels, as you can see here. Okay, so second use of Ichimoku, first use was to identify trends, and second use is as support and resistance. Okay, thirdly is for confirmation. So the Chico span is used to confirm the signals that's generated by the Tenkan-sen, Kijun-sen, and Senko span. So the Chico span is the lagging indicator here. And you can see I've shown you guys what it looks like on TradingView. So it confirms if it's above the current price, then it confirms a bullish trend. And if the blue line is below the price, then it is a bearish trend. So we just use this for confirmation of the trend. So after you've analyzed or you've gone through the first two steps, so you identify the trend and we analyze the different lines, then this would be the third way to confirm the trend. Okay. Next, we have as buy and sell signals. So these depend on the positions of the various components. So for example, if a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen, and a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so all of these different lines can, when you analyze each of them, if they all line up nicely, then you have a very strong either bearish or bullish signal. Okay, so how do we use the indicator, the Ichimoku indicator effectively? So the overall trend is up when the price is above the cloud and down when price is below the cloud. So traders will often just use the Ichimoku cloud as an area of support and resistance depending on the relative location of the price, which is what we talked about in the second step, and we've shown you how to do this as well. So the cloud provides support and resistance levels that can then be projected into the future. So this is what sets the Ichimoku cloud apart from the other technical indicators that only provide support and resistance levels for the current date and time. So as I mentioned earlier, we like to typically just look at the cloud if you are looking for an indicator that's very easy to read, or you cannot, you don't really have the time to analyze each of the lines. Ooh, okay. So yeah, as I mentioned, this is how we use it by just looking at the cloud strength. So price is moving below the cloud, giving us a bearish signal. Here, when price crosses over, this is where we see a trend reversal, and you can see exactly right when this happens, price moves in an uptrend, and it's also moving above the Ichimoku cloud. So it's all very bullish signals. So this is what you want to look for whenever you are using the Ichimoku cloud. Okay, so far, if there are any questions, feel free to let me know in the chat. Okay, if there are no questions, we'll move on to our next indicator that we're gonna look at. So in this example, we're gonna look at using the moving average indicator. So price XMA is a cross-trading technique that is quite simple to use. So it involves using two moving averages of different periods to analyze price movements and generate buy or sell signals. So if you're unfamiliar, just a brief introduction to moving average indicator. So the moving average is basically a smoothened line, as you can see here. It's a smooth line that represents the average price over a specific number of periods, of which you can control when you're using MT4, MT5, or TradingView. So it helps to smooth out price fluctuations and highlight the underlying trend. So there are a couple of steps for this strategy. Firstly, you choose two moving averages. For example, here we are using a shorter period moving average, which is 20-day, and a longer period moving average, 50-day. The buy signal occurs when the shorter moving average, so in our case, the 20-day, crosses above the longer moving average, suggesting a upward trend. So in that case, we would then consider buying. For a sell signal, when the shorter MA crosses below the longer MA, then it indicates a possible downward trend, and then we will consider selling. So simply put, if your 20-day moving average crosses above the 50-day moving average, it's a buy signal. If the 20-day moving average crosses below the 50-day moving average, it's then a sell signal. So this works best in trending markets, so either moving upwards or downwards. It can produce false signals in choppy or sideways markets, so it's essential to practice and consider other factors like market conditions, risk management, and other confirmation indicators before making these trading decisions. Okay, next, let's take a look at Golden Death Cross. So this is a trading strategy that's based on the intersection of two important moving averages on a price chart. So it's a term used to describe the point at which a shorter term moving average crosses above a longer term moving average. So it indicates a potential bullish trend reversal. Conversely, you can see over here, so when price moves above, it's positive, and in this case, over here, we can then expect it to be bearish. Okay, when the death cross, the death cross will be over here when the shorter term moving average crosses below the longer term moving average, then it indicates a potential bearish trend reversal. Okay, so over here we have the golden cross, and here we have the death cross. My last point is confirmation and analysis. So it's important to note that these signals are not foolproof, so you should be using them in combination with the different technical analysis tools as well, like Ichimoku, and a couple of indicators that we're going to talk about in the next few slides. Okay. Next, we have channels. So we already talked about this earlier, but here I've highlighted a resistance level from the previous touch on the trend channel. So at this level, this is my resistance, and you can see price from this swing high, price has actually touched this level, making it an overlap support, but then we see it drop down again, touch the bottom of the channel, and then it's moving within this channel. So since it's continuously moving, and you can see for a really long time, this has really clear upside, or rather upward pressure. And that's why once price breaks through this overlap support or now resistance, then we can say that we can expect it to continue within this upward channel. Okay, so let me know in the chat which one of these looks better to you. Yeah, so the first one definitely looks better. And here we're using a moving average, natural moving average. Okay, let me show you guys the next slide. So now I'm using the natural moving average, and you can see I completely agree the first one definitely looks better. And the reason for this is because price has touched this level many times before it crosses over. So this is actually maybe a better representation of what we can expect for a reversal, or rather how we can identify a trend reversal. Since price has touched it so many times, showing us a really clear upward movement, then whenever there is a crossover over the natural moving average, then we can expect the reversal to be pretty significant. Over here, it's not that this chart is bad. Of course, we're using the same indicator, it's showing us the same things, but the difference between the two is just basically the settings, which is why it doesn't fit as nicely as the first chart. So in this one, once price reverses over here, you can't really tell whether price is actually going to reverse or if it's going to continue in the upward trend. Double break. Simply put, we are just looking for a break out of the trend channel. So this is a very obvious sign that the trend is about to reverse. Once we see this very clear, so we have the natural moving average again, which is the black line, and we are also combining this with our trend channel. So as I mentioned earlier, we need 2 touches at least on top, 2 touches at the bottom at least. So very clear upward pressure here. Looks like it's going to continue. But how we know price is actually going to break out is once we have double confirmation from the crossover on the natural moving average and also breaking out of this ascending trend channel. Okay, so you can see that's exactly what happened. It fell really sharply after that. Okay, next we have confluence. So the first chart, I'm just using a ascending trend channel. And then over here, I've included the trend natural moving average. So by making use of more than one indicator, or I guess trend channel would be a graphical analysis tool. So by combining all of these tools, then you can really increase your chances of making profit or getting out of a trade if the trend reverses. So that's what we mean by confluence. Here we show you some more examples. From the previous slide, we only had the natural moving average as well as the ascending trend channel. Now we've included the Ichimoku cloud, also giving us bullish signal. And now I'm also using the golden cross or death cross technique. Okay, but all pretty bullish over here in this case. Next slide, I'm also using these same indicators here. It's just to show you guys what each of these mean. So because so many of our indicators are giving us this bullish signal, then we can expect price to continue within this ascending trend channel because there are no signs that it's going to break out. So here we can see that's exactly what it did. It bounced off of the bottom of the trend channel and it's continuing within it. Okay, let me know if there are any questions so far. Okay, I have a question. Does this work only for trending markets? So that's a really good question. And the answer to that is we typically would advise to only trade or go in for the trade when markets are trending. And the reason for this is because, and when I say trending, I mean upwards or downwards. Because if it's ranging, there's not much market movement and you cannot really make much money from ranging markets, if that makes sense, because the movements in the markets are what makes you your profits. So all of these techniques that I've gone through today are mostly for trending markets, or not mostly, are all for trending markets, because that's what we typically recommend you to go for, especially if you are a beginner trader, because it's easier to trade when prices are moving up or down as opposed to staying ranging. Okay, I hope that answered your question, but thank you so much for the question. Okay, let's move on. I just have a couple more slides and then I think we can call it a day. So next, let's go through a couple of disadvantages of trend trading and how exactly you can overcome these disadvantages. So firstly, we have false signals. So trend trading can generate false signals as well, especially during periods of market consolidation or trend reversals. So if you act on these incorrect trend assumptions, then it can definitely lead to losses. Next, we have late entries. So what we mean by this is when a trend following strategies may result in entering trades after the trend has already been established. So you can miss out on the initial price movement and potential profits. And then you might see yourself in a position where price is already reversing when you enter the trade. Choppiness is our third disadvantage. So although I mentioned that we are looking for trending markets, you want to stay away from really volatile or choppy markets because these trends tend to be short-lived and erratic, leading to frequent changes in direction and difficulty in capitalizing on sustained trends. So whipsaw trades is a phrase that describes when traders enter and exit positions quickly due to volatile price movements. So these can result in losses, and this typically occurs when rapid changes in price direction occur. So that's pretty similar to choppiness. So don't mistake, when I say trending markets, don't mistake that for choppy markets. Okay, limited profits in ranging markets. So this is also part of my answer to the question from earlier. So trend trading might struggle to generate profits in markets that lack a clear and sustained trend, because these trades may get caught in a range-bound price movement. Okay, requires timely decision making. So when you identify the start and the end of trends accurately, this is pretty difficult to do. So it requires timely decision making and constant monitoring, which may not suit all traders' lifestyles or availabilities. So it really depends on your own trading strategy, whether you are a scalper or if you're in it for the long run. Noisy price data is pretty related to choppiness, so I'll just briefly talk about it. In this case, we're talking about noisy price data or short-term fluctuations, leading to a misinterpretation of the underlying trend direction. So how exactly can we overcome these disadvantages? So to overcome these advantages, you can adopt a couple of strategies and techniques. Firstly would be confirmation signals. So we've talked about, for example, for Ichimoku, we're talking about the different lines and what they represent. So these can be used as confirmation signals, or you can use additional technical indicators or chart patterns like we saw earlier when we're talking about confluence and using different indicators to support a trade or to support a trend. So when you use multiple indicators and technical analysis tools to confirm your trend signals before entering a trade, it can help to filter out any false signals and also increase the accuracy of trade entries. Diversification. So you should combine trend trading with other trading styles or strategies to mitigate the risk and reduce reliance on a single approach. So pretty similar to what I talked about confluence. Next, time frame analysis. So I'll talk about this really quickly in the next few slides. Risk management, we talked about this as well. Implementing strict risk management techniques such as setting stop loss, orders, and position sizing based on your risk tolerance. Backtesting and optimization, we have a webinar on this, so you can go ahead and take a look. And market monitoring, it's important. Basically, we're talking about fundamental analysis, and it's really important to regularly monitor the financial events and economic data releases. Okay, so I wanted to talk a bit about time frame analysis. Here we have a very unclear market structure on the M15 timeframe. And there's no clear movements in price. So I talked a bit about that in the previous slides when we're talking about, I think it was support and resistance levels. Next, when we change the same asset or the same price chart to a H1 view, we see it a lot clearer. So there's two criterion you should look out for. Firstly, clear swing high or swing low. Secondly, a clear trend between the starting and ending points. So you can see here I've added a little quote at the very basics. The clearer the swing low and swing high, the clearer the trend between these 2 points, then the more accurate your analysis will be. So this is just an intro, but we have an entire webinar on multi-time frame analysis. But basically, it just involves analyzing the market from multiple time frames. So that's what we're talking about. Okay, so a couple of things to look out for on the higher time frames. We have the key graphical levels, so your support and resistance levels that we mentioned earlier, trend lines, trend channels, breakouts of these trends, and then big moving averages. We talked about those, Ichimoku cloud, big Fibonacci levels, and price action. So what we mean by price action is past, present, future prices, and the momentum from previous bars to dictate your strategy. So you can see how this all ties in. Basically, as long as you use multiple indicators, look at the different time frames, then you can increase your chances of making a profitable trade and trading according to trends. Okay, that's all the time I have for today, and just nice, we are done with our slides. So thank you guys so much for joining me today. I hope you guys found it helpful, and I will see you guys next week. Bye!